Imagine a world where high performance meets sustainability, where every ride isn't just fast, but meaningful. That's the world that TurboTrek is building. We're not just a bike company, we're a movement, a new force in premium cycling that's rewriting the rules of speed, purpose, and scalability. In our first year of operations, we focus on two high road segments, mountain and speed bikes, achieving double-digit market share, launching our four specialized brands, and expanding across North America and Europe. We ended last year with strong reputation, a growing customer base, and an ambitious product roadmap. Now we're entering a critical second year, and that's one all about scale, precision, and operational excellence.
During our second quarter, TurboTrek made bold strategic moves that quickly positioned us as a serious contender in the market. By the third quarter, we had captured 22% overall market share, leading the speed segment with 58.47% and securing second place in mountain with 28.27%. This momentum generated over 388,000 in revenue and a 48% gross margin. Despite a negative net income due to strategic investments, our brand perception remained strong with a stakeholder reputation score of 64. In quarter four, while our overall market share declined due to the lack of market research, we retained 39% in the speed segment and rebounded financially. Revenues rose to nearly 490,000 margins to 59%, and our cost efficiency improved significantly. TurboTrek is agile and financially disciplined. We're learning fast and we are poised to lead.
Let me begin with the brief overview of the market we are operating in. Over the past quarter, we have seen encouraging signs of the economic recovery. GDP growth is expected to approach 3%, especially in regions like North America and Europe, and that directly impacts consumer spending in our industry. We also operate in highly competitive market, and right now, all five major players, including us, are present in New York. And next quarter, with our expression of Amsterdam, we will be one of the four companies operating in that Europe market. These shifts show how quickly the industry is globalizing. And in terms of demand, the industry is becoming more dynamic and segmented. Our focus is on two core categories, mountain and speed bikes. While the speed segment is smaller in total size, it's now for higher margins and performance-driven consumers. Mountain bikes, on the other hand, generate a strong volume of our currently or our most profitably category. We have also seen a shift in consumer behavior. Price sensibility remains high, but buyers are increasingly looking for expect service and real value, not just the lowest price. That is where the TurboTrek has strong opportunity to lead, not just by offering quality products, but by building better relationship in store.
TurboTrek is entering quarter four through quarter six with a focused data-driven strategy to solidify our leadership in the speed segment and regain momentum in mountain. Our brands, including Rush Ride and Hyperflow, are projected to remain profitable with strong price judgment scores, while Crack Rider and Rush Ride showed solid brand acceptance during quarter three. In quarter four, we're launching Rock Mountain, Speedflow, and Crack Mountain. It's part of a structured rollout that continues into quarter five and quarter six with Furious Race and Climbing Monster. These launches will keep our portfolio fresh and aligned with performance-focused consumers. Our messaging will be anchored in high-performance positioning through campaigns like On the Speed, with targeted digital and sports media spent to ensure consistent visibility. To address our current absence in organic search engine marketing, we're implementing a strong search engine organization strategy to boost search rankings and digital discoverability. While competitors like Sprint and Cyclo are increasing spend, we're defending our space through brand differentiation, innovation, and pricing strength. The retirement of Trailblazer and the rebrand of Crack Rider to Crack Mountain are key steps in modernizing our portfolio. We'll track success through clear KPIs, such as brand judgment scores above 70, top 5 search engine marketing rankings, and improved ad copy review ratings across the last 2 brands.
And starting in Q5, we are operating our second store, this time in Amsterdam, which will help us reach new markets and double our current demand from 341 to 720 units. To support that, we have increased our sales and service team for 6 to 11 members, distributing them across both locations with clear specialization. In New York, we will have 2 mountain bike specialists, 2 speed bike specialists, 1 customer service agent, and 1 flexible support member. And in Amsterdam, 2 specialists in mountain, 2 in speed, and 1 in customer service. This setup is designed not only to handle increasing volume, but to deliver expert category-focused service to every consumer. Our team is also receiving continuous training, not just in the technical aspects of our products, but also on communication, active listening, and how to create a memorable experience for every buyer. We believe that our advantage is not just in having more people, but in having the right people in the right roles and with the right focus.
From the very beginning, our human resources strategy focused on attracting and retaining talent by offering compensation above industry average, boosting both morale and productivity. In Q2, we introduced our first structure packages. The sales force received a 19,000 salary, expanded health coverage, and a 2% pension, achieving 80% projected productivity. Production workers received a modest 11,000 with minimum benefits, and supervisors got 15,000 with expanded coverage. As tensions emerged between teams over wage gaps, we adjusted. We raised salaries, offering 21,000 to the sales force, 12,500 to production workers, and 17,000 to supervisors, ensuring fairness while preserving performance. In Q4, we reinforced this strategy. Sales and supervisory compensation remained competitive, while production workers saw an increase to 13,000. Productivity remained strong, with a 70% for sales and a 71% for production. Our approach proved successful. Investing in people pays off when it's balanced with performance and equity.
Currently, we operate at just 58.3% of our fixed capacity, well below the industry average of 75%. This underutilized asset is now being leveraged to meet anticipated demand growth across both New York and Amsterdam. By the end of Q6, we aim to reach 75 to 80% utilization without any fixed cost increase. But we are also planning for smart growth. If real demand exceeds predictions of Q6, 5, and 6, we're ready to expand capacity with a new 3D printer, adding 8 units per day. This is not speculative. It's a measured response tied directly to confirmed market signals and financial projections, keeping our margins safe. Operationally, we are already leading. Our productive rate stands at 71%, the highest among our peers. But we're not settling. Through employee cross-training, production planning, and advanced quality controls, including statistical process control and supplier quality integration, we aim to push that number to 72 or even 73% by Q6. What makes us different is our alignment. Manufacturing isn't operating in isolation. It's synced with regional sales trends and segment-specific forecasts. This coordination helps us to avoid inventory bottlenecks, eliminate waste, and deliver exactly what our customers demand when they demand it.
Our financial strategy for the next 3 quarters is boiled on 2 priorities: a stabilization and a return to profitable, sustainable growth. We closed the last quarter with an earnings per share of less $8, which reflects our bold investment in expansion, research and development, and customer experience. In Q4, our most aggressive quarter, we expect our deepest loss of 1.5 million. But this is a strategic inflection point. By quarter 5, we project a positive net income of $447,000 and an earning per share of $9, which will grow to $15 by quarter 6. These improvements stem from operational efficiency, stronger brand positioning, and market expansion, especially in Europe with our new Amsterdam store. Importantly, we have made this investment without using debt. We have remained disciplined and transparent, aligned every financial decision with our marketing, operation, and human resources strategy to maximize long-term value. To continue executing this strategy, we are seeking an equity investment of $2.5 million through the issuance of 25,000 shares at $100 per share. This is not a funding request. It's a high-value investment opportunity based on our projected earnings per share of $15 in quarter 6 and using a conservative price-to-earnings ratio and expect a return on investment of approximately 286%. We did not rely on the fall of 10x multiple. Instead, we conduct a professional valuation using Refinitiv Bacon, the platform used by London Stock Exchange, and choose the median multiple of the industry, not the highest, ensuring our valuation is balanced, realistic, and investor-friendly. These funds will direct toward product innovation, market expansion, digital transformation, and operational enhancement, all of which will accelerate our path to long-term profitability. At TurboTrek, we are not just building bikes, we're building a business that's ready to lead in the performance, sustainability, and value creation. This is the right moment to invest, and we invite you to grow with us.
Welcome to our recap of 6 quarters of strategic business decisions. Let's take a fast-paced tour through product launches, expansion, marketing, and operations, all designed to drive growth. In quarter 1, we laid the foundation by launching Trailblazer 1.1 and Hyperflow, targeting mountain and speed segments. We opened our first store in New York and invested heavily in fixed capacity, preparing to scale operations. In quarter 2, we expanded the product line with Crack Rider and Rush Ride while beginning to build market presence. Our first sales brought in $388,000 in revenue with 5 salespeople and a clear focus on activation. Quarter 3 saw us entering Amsterdam, and we didn't add new brands but reinforced our portfolio, and sales grew to nearly $490,000 with balanced production and no lost sales. We also began modest digital marketing to boost reach. Quarter 4 was a turning point. We launched Rock Mountain, Speedflow, and Crack Mountain, and initiated over $1 million in R&D for tires and gear systems. With a solid production plan, sales rose to $940,000, and we introduced system improvements. In quarter 5, we released the Furious Race with enhanced specs, opened a 3rd store in Bangalore, and hired 6 more salespeople. Production ramped up to 1,156 units, perfectly meeting demand. Revenues hit $1.65 million, and we continued investing in product quality and brand visibility. Quarter 6 closed strong with the launch of Climbing Monster, a premium mountain bike with high-end features. We boosted our sales team to 23 people, expanded operation capacity to 2,000 units, and reached $2.3 million in revenue, our best quarter yet. Across all 6 quarters, we steadily scaled operations, grew our product portfolio, and invested in innovation, sustainability, and customer engagement. The results: strong market entry, increased profitability, and a platform for long-term success.
Together, we're not just writing the future,
We're building it.